My name is Axel Drwenski. I'm head of research at Commerz Real. We belong to a Commerz bank, so I know a little bit about the banking sector. My first slide, I think, can tell everything. Is there a party? Is there a party going on? Is the glass half empty? Is it half full? Is there still champagne? But I think we can be sure that this guy is not a tenant looking for space in Munich. So let's have a look into the economy. The Eurozone economy has grown since autumn 2016 as an average quarterly rate of 0.6%. And the end of the upswing is not in sight. The driving force is the ECB, which is, for the people who are not from Frankfurt, right there. And the expansionary monetary policy, we've got low interest rate, and this makes high debt levels possible and allowing consumption and investments on a very high level currently. The euro appreciation we have seen during the last quarters or month, which is reducing the price competitiveness of companies producing in the Eurozone, is unlikely to curb growth on a lasting basis from our point of view. Very strong sentiment in industry is one argument against this. This is the unemployment rate of the Eurozone, which is a fat line here. Germany is not this red one. Germany is here. The good news is in this chart for the retailers. Falling unemployment is a main factor pointing to a gradual acceleration of wage growth in the next quarters or months. In September, the unemployment rate in the Eurozone dropped to 8.9%, which is the lowest level since the beginning of 2009. And that means at the peak of the of the unemployment, we had around about 18 million people unemployed in the Eurozone. Now we are below 15 million. That means 4.5 million people got a job during the last 4 years. And there's no sign that this will change. And the sentiment in the manufacturing manufacturing industry is on the highest level since the beginning of the century. There are no signs the party will end soon. Okay, service is not as good, but will follow, quite sure. So let's have a look in the European office market. 27, a new record-breaking year for take-up. The leasing volume remains very robust in most of the European countries or markets. And when you compare the first 9 months, 2016, with this year, it looks like that we can register a new record year. Let's see. So we are just a little bit ahead. Thanks to the ongoing job growth in Europe, the average vacancy rate decreased to the lowest level since 2008. But there's an increasing evidence of corporates struggling to fulfill their requirements, looking for space. And this is not only in the grade A segment. But maybe you can see that we are expecting a little tick up in the vacancy rate. So it's not falling further. There are signs that the supply side is responding to the strong rental growth and the low availability of some European markets. This increase in development activity is providing corporates with some much needed additional supply, and pre-letting activity in a lot of markets has increased. In 2018, the development pipeline will be more significant than this year, with a majority of increases concentrated in Paris, Dublin, Berlin, London, Warsaw, and hopefully Munich. But in comparison with the last cycles, 2008, around about 2000, this is not a bubble. It's not so much we've seen in the last cycle. So yes, it's good. The pipeline is increasing, but it's not a problem. There's no risk from our point of view. Let's have a look into some of the markets. Stockholm. I'm now comparing the prime rent from the market trough to the current situation, the vacancy rate, and I give a kind of forecast. So the prime rent increased by nearly 60% since the trough of the market. The vacancy rate is currently around about 8%, coming from 13%. And we are expecting that the prime rent will increase further, around about 2%, and the vacancy rate will pick up. But we are talking about maybe 1 percentage point. This is not a problem at all. Berlin. Prime rent increased by 45%. The vacancy rate is currently 3% only, coming from 12%. Berlin's mentioned as young, fast-growing, and undersupplied. Most of the researchers I talk to believe that Berlin is one of the fastest-growing cities in the next years. I believe it too, in regards of population and also rent. Take-up increased significantly during the last years, and 2017 might see a new record level, but in proportion to the total stock of Berlin, the level is okay. It's not very high, it's just okay. One of the key drivers of the markets is the employment growth. We're expecting for the next 5 years, on average, 2.4% average growth on the employment side. In Germany, the average is 1.4%. And most of the new jobs are created in the technology sector. Berlin is becoming, or is already, we have to discuss it, one of the most interesting cities for startups. But what will happen with all the wonderful startups and with the wonderful plans when there's a recession? I'm not talking about a doom scenario, just normal recession. I still remember the euphoria in 2000. Now we call it the dot-com bubble. So let's see what will happen with all the wonderful startups in 10 years' time. We're expecting prime rent growth by around about 4% next year, and the vacancy rate will pick up just a little bit. Frankfurt, the increase is only 14% since the trough. So it looks like that the banking sector, the main industry here, is not willing to pay very high rents. Yes, rents are increasing, but they are not skyrocketing. The vacancy rate is 10%, which is for Frankfurt really, really great. We are coming from 20%. And we're expecting prime rents to increase a little bit more, around about 2% this year and the following year, and the vacancy rate to fall further, but not dramatically. So all these bankers coming now to Frankfurt, they will find some place, but I'm not quite sure if they will find it here in the city. They will find it maybe in Eschborn. In Munich, prime rent went up by nearly 30%. The vacancy rate is now 3%. This was the tenant with the glass and the party. Or not the tenant, the trough was 10%. The vacancy rate in Munich is so low currently that companies are starting to relocate out of town. BMW Group, for example, relocated some parts of the business to Unterschleißheim. You need a map to find Unterschleißheim. And the same with Deutsche Pfandbriefbank. They recently took 11,000 square meters in Garching. This is so far not a trend, but I think this is something we have really to watch closely. Prime rents will increase dramatically by 4% in Munich, and also the vacancy rate will more or less be stable. France, Paris, only 18% higher than the last trough, from the last trough. The vacancy rate, again, only 3%, coming from 6%. We're expecting prime rents to increase, but the vacancy rate, there will be no major change. London, there's a Brexit and the rents are falling, but in comparison with the last trough, it's more than 60% higher. So it's still very high. The vacancy rate in the city, or in the total market, central London, is around about 6%, and it was 9%. We are expecting that prime rents will fall a little bit further, not dramatically. We are talking about maybe minus 2%, maybe 3%, maybe 1%, who knows. And the vacancy rate to increase a little bit more, a little bit. Brexit is not a catastrophe for London, even if we don't know what Brexit means. Dublin. Yes, 5 years ago you should have bought something in Dublin. Prime rent increased by more than 100%. The vacancy rate is currently 7%, coming from 25%, 24%. We're expecting prime rents to increase further, 3%, but the vacancy rate will pick up a little bit. So where are all these bankers going from London to Dublin? Dublin is a very small market. I think they have to build something. So at the end, this is now the rental index we are producing with, I think, 22 cities in Europe, 9 cities in the US, and 12 cities in Asia Pacific. At the end of 2016, the European Office Rental Index, our index, exceeded the last record level, this time. And we're expecting further growth. As tight market conditions continue to applies upward pressure on rents, we are expecting our rental index to increase next year by 2% and the year after the next year by additional 2%. Hopefully. Let's have a look to the investment market. These are the transaction volumes Europe, everything, office, hotel, apartment, retail, logistic. There's a strong pressure to invest, and I think you all know of this to real estate, to invest in real estate, and capital continues to flow into Europe from all corners of the world. Are there enough buildings to be traded in the key cities like London, Paris, and Berlin? Is there enough availability? To my knowledge, not. Germany is currently seen as a safe haven in Europe, replacing the UK after the Brexit votum. I don't think that the current political situation in Germany will have a major change in this view. There are no signs at all that there will be significant changes in the next months. If this statement will be proven wrong, I hope you don't remember this presentation and my name anymore. This was the total volume in the first 9 months of the last year, and here we are this year, so we are more or less on the same level. Is real estate too expensive? Low global bond yields and interest rates are making real estate yields look attractive. This is the average prime yield for 22 cities in Europe. But the gap between the office prime yield and the bond yield is narrowing. Let's have a look into some markets. In 2012, it's only 5 years ago, by the way, the prime rent in the German cities, the prime yield had been around about 5%. And the German bond yield, wonderful times, was close to 1%. 1 year later, the gap between the Frankfurt and the 10-year government bond yield was 335 base points. 330, and in 2015 it was 380. 1 year later, 412 base points between the 10-year government bond and the Frankfurt prime yield. But now the wind changed. This year, it's only around about 300%, the current figure. And if I'm looking now into my crystal ball, we're expecting a further decrease. It's only 260% base points, excuse me. And if you ask people, emerging trends in real estate 2017, 16 is wrong. PwC and ULI every year they ask people, do you think that real estate is too expensive? What do you think? Is real estate prime assets overpriced? More than 50% believe yes, it's overpriced. And I would like to meet these people who disagree. Where are they investing? Is anybody? No. Later. On average, the gap between the bond yield and the average prime office yield is around about 350 base points, currently, on average. But let's have a look. In maybe 3 years' time, 2020, the gap will narrow. It will melt down to maybe 270 points. And then we are back to 2009, 2011. So the question is the party over? No, I don't think so, that the party's over next year, and maybe 2019. But we all should remember, after every good party, the next day can be really, really tough. Thank you very much.